Good morning. I'm Gary DeWaal, and this is Bridging the Weeks for June 25th to July 13th, and today is July 16th, 2018. A commodity merchandising firm was fined $6.55 million by the Commodity Futures Trading Commission and the Chicago Board of Trade combined for attempting to manipulate wheat futures contracts. However, its transaction activity may have constituted ordinary commercial conduct, but that was not sufficient to avoid the regulator's wrath. Separately, the Financial Industry Regulatory Authority asked member firms voluntarily to disclose details regarding their associated persons and their affiliates' activities related to digital assets. But the nature of activities FINRA is curious about is very broad and includes such persons' futures activities. I am just back from 2 weeks of travel, 1 week to Paris and London for business, and almost 1 week to Colorado to be inspired by the Rocky Mountains. So I can catch up on the piles of papers on my desk as soon as possible. Let's get started. Lansing Trade Group agreed to pay $6.55 million in aggregate fines to the Commodity Futures Trading Commission and the Chicago Board of Trade for alleged attempted manipulation of certain wheat futures and option contracts from March 3rd to 11th, 2015. The CFTC also charged that Lansing aided and abetted an attempted manipulation of the cash price of yellow corn on February 19th, 2015. According to both the CFTC and CBOT, Lansing engaged in its attempted manipulation of wheat futures to benefit its own futures and options positions. The CFTC said that Lansing assisted in attempting to manipulate the price of corn as a favor to an unnamed third-party grain company. Lansing is a commodity merchandising firm headquartered in Overton Park, Kansas, that trades grains and oilseeds, feed ingredients, and energy products. Neither the CFTC nor the CBOT's settlement orders reflecting Lansing's settlement indicated whether the firm's attempted manipulation achieved its objective to raise prices. Lansing agreed to pay a fine of $3.4 million to the CFTC and $3.15 million to the CBOT to settle these matters. The CBOT fine against Lansing was the largest fine issued by the CBOT since its merger with the Chicago Mercantile Exchange in July 2007. Although it was challenging to follow the facts of this matter from reviewing the cryptic language of the CFTC and CBOT settlement orders, it appears that the type of conduct engaged in by Lansing was not atypical of its ordinary operations. According to the CFTC in a buried footnote, quote, as a wheat merchant, Lansing's course of business includes the purchases, cancellations, and loadout of wheat for delivery. Irrespective of whether the cancellation and loadout of the below milling grade wheat was a legal open market transaction, Lansing nonetheless engaged in manipulation because it had the improper intent to move the prices of futures and options contracts being traded on the Chicago Board of Trade in Lansing's favor through this conduct, end of quote. However, as both the Commission and at least one federal court have noted previously, legitimate transactions plus improper motive or intent equal unlawful commodities manipulation. I have a lot more details regarding this matter on the article version of Bridging the Week at www.bridgingtheweek.com. Check it out. The Financial Industry Regulatory Authority asked all member firms voluntarily to notify their FINRA regulatory coordinator in writing if they, any of their associated persons, or any of their affiliates currently engage or intend to engage in any activities related to digital assets, including cryptocurrencies and other virtual coins or tokens, even if such assets are not securities. FINRA encourages all member firms to provide such information promptly and to update their regulator coordinator through July 31st, 2019 if they, their APs, or their affiliates begin or intend to begin engaging in a new activity related to digital assets that was not previously disclosed. The scope of activities FINRA seeks information regarding is quite broad. Among the activities covered by FINRA's request are purchases, sales, or executions of transactions involving digital assets, including in a pooled fund, investing in such assets, or in derivatives, creation or management of a platform for the secondary trading of digital assets, or to provide or facilitate clearance and settlement services for cryptocurrencies and other virtual coins or tokens, accepting cryptocurrencies from customers or mining cryptocurrencies, and recording cryptocurrencies and other virtual coins and tokens using any type of blockchain technology. FINRA does not seek information from member firms that previously was provided to their FINRA regulatory coordinator in response to a direct request, through a continuing membership application, or through their 2018 Risk Control Assessment Survey. Earlier this year, Arthur Munir, aka Arthur Brightman, agreed to be suspended for 2 years from association with any FINRA-regulated broker-dealer to settle FINRA charges that, from February 2014 to April 2016, he participated in the development of Tezos, a blockchain technology project, without notifying the broker-dealer he was then employed by of such activity as required by FINRA rules. FINRA noted in a footnote to its voluntary request for information that it is not imposing an affirmative obligation on member firms to affirmatively seek out information related to associated persons outside digital asset activities. Instead, it is solely, quote, interested in learning from firms how they currently handle notifications regarding participation in activities related to digital assets such as cryptocurrencies and other virtual coins and tokens, end of quote. And finally, the Commodity Futures Trading Commission awarded its largest whistleblowing award to date, $30 million for providing key information that led to a successful enforcement action. According to the website of the CITO Law Offices, the CFTC's award was given to a person who provided information to the CFTC and the Securities and Exchange Commission that led to the agency's filing and settlement of enforcement actions in 2015 naming J.P. Morgan Chase Bank over an alleged non-disclosed conflict of interest. The enforcement actions were brought over J.P. Morgan's alleged failure to notify clients of the bank's wealth management business of its preference, because of economic incentives, to invest client funds in certain commodity pools, hedge funds, and mutual funds managed and operated by an affiliate, or in similar third-party managed vehicles that provided payments to the bank. J.P. Morgan resolved both actions by agreeing to pay an aggregate fine of $167.5 million, disgorgement of $127.5 million, and almost $12 million in pre-judgment interest. Well, that's it for this week's edition of Bridging the Week. As always, there is more information in each article and more articles on the article version of Bridging the Week on the website. Check it out. I'm Gary DeWaal. Have a great week, and until the next edition of Bridging the Week, ciao.